Hi everyone, welcome to our second video on the cash flow statement. In this video, we're going to kick off with a review and one more problem by completing a statement of cash flows with the indirect method, just to reinforce that for you. And I hope you've watched the previous video to see how it gets constructed. And then we're going to talk about how to use that information in order to prepare some ratios. Now, in addition to the ratios shown at the end of this chapter, you should be checking out Appendix A for a full ratio analysis of financial statements, in addition to providing some extra ratios that you can look at to inform yourself on the health of a business. It also reviews and teaches you how to perform a horizontal assessment and a vertical assessment. Now, this is basic middle school algebra, course 1 algebra, so I'm not going to spend a lot of detailed time on it, but if you do have questions, please reach out and I'm happy to help you. And so with that, let's get started. So we're going to complete a statement of cash flows for virtual company. The following information presents their balance sheet and their income statement, as well as some additional notes. What I'd like you to do is go through, prep, and make sure you can replicate the information that you see. What's really important is that you have a good process and a good understanding of where every line in your cash flow statement comes from, so that when you do those practice problems, you really do understand how it all works. All right, so let's review our steps. We begin with our balance sheet prep. So you want to set up your own balance sheet and replicate these changes. And I highly recommend, if you're in our course, that you utilize the template that's been provided in our module and go ahead and type this all in. You want to have that available so that you can see clearly where each line comes from. Use formulas, the equals difference, right? Putting in so that you can do this rather quickly. And if information changed, you'd be able to adjust your template with ease. We then get our income statement. It's here and available. This needs no prep, but I am going to make note of my net income because this is where it's going to start. And I also can see here that I have some depreciation expense that I'm going to want to manage and my gain on the sale of land. So I do have some elements from this statement that will kick off my cash flow process. And then I have gone out and gathered up the additional information that I need to construct the statement of cash flows. So investments that originally cost $30,000 were sold for proceeds of $47,500 in cash. I have some investments that I purchased for $50,000 in cash, some plant assets that I've purchased for $66,000 in cash. I've made some cash dividends in the amount of $8,000. And you can see here there are no non-cash transactions for virtual company. All right, everybody. Now we're ready to craft our statement of cash flows. You can approach this from one of two ways. You can either pause the video, try it on your own, and then come back and compare, or walk through with me, pausing as you go to craft your own notes, write down and double check each piece of information. Both ways are fine. It's whichever way suits you best in your learning. So let's begin with a proper structure. Always label, always use headings. That information is really there to guide us and clarify our information. So top of the statement of cash flows, name of the company. It is a statement of cash flows in the indirect method and the time period for the statement. This time period should match the time period on your income statement. Then we're going to get our structure going, right? All these headings really do matter. First line, cash flow from operating activities. And I'm going to list the net income right off my income statement. That's always going to be your starting point. Then I'm going to make adjustments. Now you can choose to write this whole sentence, or you can just write adjustments, colon. That's fine. It's understood what the purpose of it is. Both would be acceptable. Now grab that income statement. We need some information from it before we put it away and move forward. So I do have depreciation expense. That was a non-cash expense, right? Remember, we didn't write any checks. There was actually no depreciation cash out. So let's add that depreciation expense back in. If we had amortization or depletion expense, it would go in at this point as well. There was a gain on the sale of plant assets in our other revenues category. This does not relate to everyday business operations, so it doesn't belong in this section. So we need to get that cash out of our section. So it was a gain, so therefore positive on the income statement needs to be subtracted on the cash flow statement. If this were a loss, it would show negative on the income statement and we'd add it back in on the cash flow. Now I'm done with using my income statement. So go ahead, put that aside, and get out your consolidated balance sheet and the note information from the company. We're going to start with our prepped consolidated balance sheet. Remember to use the change column for the dollar amounts. And we're going to start with the current assets. Virtual had 2 current assets. Their accounts receivable increased in 2018, and their prepaid insurance decreased in 2018. Remember, this is an area where we're going to flip our amounts, right? And we flip them because when we purchase those assets, when our receivables are managed, right, it changes the amount of cash coming in or going out. So if accounts receivable increased, that means more was purchased on account, and we want to subtract that cash out of our net income. It was not paid in cash. So an accounts receivable increase means minus $1,180 on the cash flow. Our prepaid insurance decreased, which means that that money stayed in our bank accounts instead of going out to pay for prepaid insurance. So a decrease in prepaid insurance adds back in $1,200. And we would go through any other current assets a company had and do the same for each one, just making sure to flip in that section. Now we're going to finish off the operating section by looking at current liabilities. So look at the current liabilities section of your balance sheet, and this goes on exactly as shown, no flipping necessary. Accounts payable increased by $800, so we show an accounts payable increase of $800. We add those together to get a net adjustments amount of $12,320. Add that to the net income, and we have a net cash flow from our operating activities of $54,950. Now go ahead. We did that. Review that. Pause, breathe, stretch, wiggle, refocus, and come back and we'll do the next section. That next section begins with a header, cash flow from investing activities. First, we show the proceeds from the sale of our investments. So we gained some profit there. We got some proceeds. The full amount we sold it for, the amount of money came in, and we add that in, $47,500 to this section. Then we had actual investments purchased. Now this is not interest made on those investments, but actual purchases of investments. So we include them in our long-term assets. And we also bought some plant assets for cash, cash out, minus $50,000 and minus $66,000. Virtual had no non-cash exchanges in the investment section. So if there are none, we don't include it. And now I just add up that section, 47,500 minus 50,000 minus 66,000 means that the net cash flow from investing was actually net on the outside, $68,500. Then you're going to pause, breathe, shake, refocus, and we'll do our final section. The final section is cash flow from financing activities. This comes by looking at our long-term liabilities and our shareholders' equity section of the balance sheet. So we begin with the payment of notes payable. This is another category where we're going to flip. So any increases will be subtracted, decreases will be added. And then you go right to your common stock and your other notes. When you issue common stock, you're getting cash. So increases in that common stock amount get added in. If you had a buyback and it decreased right in your notes, you would subtract. But we did pay dividends, $8,000 out. Add those three together, and we have a net cash flow in our financing activities of a minus $3,000. So now we just have to add our three categories for totals. We add the operating section plus a negative investing section plus a negative financing section. And we do indeed match our change column, which is to say we had a negative $16,550. Our cash balance was lower by that amount in 2018 compared to 2017. So these are not difficult, but they require you to follow the same steps each and every time. And now that you've got two very good templates, one from the previous video and one from this video, we are ready to move on and talk about what we can learn from this and our other statements about the health of our business. So now we are moving into assessment of our information. This section of Chapter 16, coupled with the appendix showing more detailed ratios and some of the assessments that you have throughout the financial accounting chapters, are really key for understanding whether a business is healthy or not, and will actually help you make decisions as we move into our managerial decision-making chapters. So even if you don't feel very confident in your higher level calculus skills, you can learn a lot from just using some basic ratios and comparisons to understand the performance of a company. And that's what I'd like you to walk away from in this section. We're going to talk about a company's liquidity position from your cash flow statement. And if you remember, liquidity is the ability of a company to pay its bills. That's it. Especially the ability to cover short-term current liabilities with the available current assets. So we're going to look in the end of this chapter at 3 liquidity ratios. There are a lot of additionals spelled out in our chapter or in our appendix, so please use those. They don't really need a lot of description. They're really self-explanatory, and they come with really nice descriptions about how to interpret and read them. So I'm going to allow you all to just kind of read and manage that on your own. But we are going to talk about free cash flow to sales ratio, and cash flow to assets ratio. So let's begin with free cash flow. This is actually a measure of the cash that you have that is free to grow your business and expand, pay down debt, right? It's the cash that isn't already encumbered or planned for other stuff. The formula for free cash flow is a simple subtraction. It is the cash flow from your operating expenses. So you're going to go get that net amount right off the cash flow statement, minus any cash that your business has planned for capital expenditures. So you're planning to buy buildings and equipment and other big expenditures that you haven't actually, bought yet, and any dividends that you've paid. So here we take their $13,840 cash planned for those capital expenditures, that $40,000, and their dividends of $440, means that after all of their plans, Propensity had a free cash flow of negative $26,600. So this actually would require them to finance, right? How are they going to make up the difference? They can't just buy all that equipment and pay their dividends and still pay their bills. So when you see negative free cash, it asks of you to think about a couple of things. First thing, how are we paying for stuff if we're in the hole? And the second is this just a one-time thing? Or is this like an ongoing, year after year, month after month? Are we constantly running short, right? If it's just a one-time thing and we know that we've got a financing plan for it and it's just a blip, that's not necessarily a problem. But if we're repeatedly negative in our free cash flow, then we're going to struggle to pay the bills. And that is a problem that the business needs to solve. Once we have our cash flow statements, we can also combine the information from a cash flow with information from our income statement and our balance sheets to get a little bit more depth of understanding on that liquidity. So the cash flow to sales ratio shows how much actual sales are contributing to our free cash flow. If you have negative cash flow, you actually can't calculate this. So you have to actually have some free cash to know what fraction of your sales revenue you have available as free, right? No imaginary numbers in accounting. Formula is really easy. The amount of your free cash flow divided by the sales revenue off of your income statement. And you can multiply that by 100 to convert it to a percent. Then we can compare that cash flow amount to our total assets. This helps us see how well our assets are being utilized, right? What percentage of our total assets is available as free cash? Again, if you have a negative number, you're not going to be able to calculate this. But if you do have cash left over, then you can calculate this percentage. In both of these cases, the bigger the number, the better. The more liquid you are, the easier time you have to pay your bills, and the more effective you are at utilizing your sales and asset resources. So now I'm going to introduce you to the appendix of this chapter. This is the cash flows in the direct method. You would only use this if your company is a cash basis company. The only difference here that we're going to notice and attend to is the difference in how we calculate the operating activities section. This is a completely optional section, so if you're feeling pressed for time, you can fast forward right to the end of the video, check out the summary slide, and be done. If you work in a cash basis business or just have time and interest, you can go through this section as well. So here is a completed statement of cash flows in the direct method. It uses Propensity Company as if they were a cash basis company. And you can see why they call it the direct method, because it directly calculates where the money came in and where the money went out in the operating section. So in the operating activities section, we begin with the actual cash collected from customers. So you go to all of your sales reporting, find that cash amount collected, separate out any credit sales, don't count, so we would get rid of those. And that is your cash in for your operation. And then we are tracking out where your cash payments went. So where did the money get spent? It got spent on inventory, so cash out to vendors and suppliers for your inventories. You paid your workers, insurance, interest, taxes, and then other operating expenses. This information comes from your income statement, right? You're looking at your expenses so that you can see where that cash went out. So we just want to track that out directly. And you'll notice, as we said, that $13,840, same net as in the indirect method. The challenge of this and why we don't use it in the accrual method is because when you have payments on account and you're recording those when they happen, not when the money is received, it gets really, really muddy. So we use the indirect method because it allows us to accommodate for that difference in timing. In a cash basis business, you're only putting things in your books when the cash is received or the cash is going out. So for cash-based businesses, it's a lot cleaner to catch up this information. The rest of the statement is the same. So there's no other differences, and all of the dollar amounts are the same, and it would end up in exactly the same place. So that only difference is just that direct method. So now let's talk about just a formula, in case you need it, of how to identify the amount of cash collected from customers. So let's say you're an accrual company, but you really just want to try the direct method, right? The way we would do that is through a basic formula that you'll see pretty similar as we move through managerial accounting. We would start with our beginning balance in accounts receivable, and we're going to add to that any sales that happened on the accrual basis, right? So any additions to accounts receivable. What was already in the accounts receivable account plus any new accounts receivable shows all the cash that a business could collect in the time period we're interested in. Then we go to the end of the time period and we look at that accounts receivable amount. What's left in there? Subtract that out and you get the amount of cash collected from the customers. So for propensity, they actually started 2018 using the end of 2017 number with $26,000 in accounts receivable, $238,000 of accrual-based sales means that they had $264,000 in cash that they could have collected in the year. They ended 2018 with $21,500 in cash or in accounts receivable. Everything else got collected. So $242,500 of it got collected. Then we go through on the following slides and use a similar formula for each and every account in the operations section. So here you see cash paid to suppliers for inventory. And remember that this is going to have two accounts involved because we first have to show the differences in the inventory account to show the assets coming in, but then we paid for them. So we want to show changes in our accounts payable and how much cash we collected from this part of the activity. So same process. You'll notice start here with an ending balance and inventory. We add our cost of goods sold. That gives us all the inventory that this company had available for sale. We subtract then what was left in inventory, and that tells us how much they actually purchased in the period. Then we work through beginning balance of accounts payable, add in the inventory they bought. This shows us all the inventory they had to pay for. We track that ending balance in accounts payable, and that means they've paid cash for all the rest of it. So what's really interesting about this process is you'll notice there's a starting place, adding something in, gives us an equal amount, and then we're subtracting out what's left to get to our cash amounts. So really fun process. You can see this at play back in the merchandise and inventory chapters in the financial accounting book in our modules if you want a little bit more detail on this process. Now we're going to continue that process with the other direct pays that we list in our operating section of the cash flow statement. Salaries payable, beginning balance in the salaries payable, we add the expense off of our income statement. That's all the salary they needed to pay. We check the ending balance on the balance sheet, and we can see how much they actually paid for salaries in the period. We do the same thing for prepaid insurance, using insurance expense as our item that we're adding in. And we would do similar items for taxes and for our other areas. So a pretty clean, clear statement with all of our cash spent on each area. And here's the side-by-side comparison so that we can see what's the same and how that operating section differs. And so first, welcome back to the folks that zoomed through and skipped out on that optional stuff. This is a summary of our cash flow and ratio analysis information. Please make sure that you review these bullet points and that you're comfortable with the chapter before we do the graded assignments. And that brings us to the end of this review. So thank you for watching. Thank you for participating. Reach out if you have any questions. Don't forget to practice the practice problems, and I'll see you next time. Take care. Bye-bye.